President Biden unveiling his massive $2.25 trillion spending plan yesterday, which he's calling an infrastructure plan. It includes raising the corporate tax rate from 21 to 28%. It also includes imposing a 21% global minimum tax to help cover the cost. We are expecting part 2 of this plan in the next couple of weeks, which will include further tax increases as well. Joining me right now is the founder and editor of the Bear Traps Report, Larry McDonald. And Larry, it's wonderful to talk with you about policy and markets. How are you expecting investors to respond to this spending plan? We're talking about, $7 trillion thrown at this economy at this point in about a year.
It's mind-blowing. I mean, if you think of the post-Lehman era, and all we had was a little bit less than $1 trillion, 700 billion, and now the institutional investors. So we run a Bloomberg chat with about 1,000 institutional investors, and there's more and more concern here, and there's a growing fear that the Obama-Biden team in 2010. Remember this, Maria? They lost 63 seats in that first midterm, the most since the 1930s. So their modus operandi right now, Democratic operatives, are to pile as much spending in the first 2 years as possible. And they will do it either through reconciliation. I think we're going to have another reconciliation bill in the fourth quarter. This current bill that's being floated now probably runs into some headwinds in the near term. But at the end of the day, we're going to be looking at a year full of potentially $4 trillion in new spending. And the implications for people watching us right now, bottom line is it's going to weaken the dollar substantially. It's going to force the Fed, per the institutional investors that I talk to, into yield curve control by the fourth quarter, fourth quarter, to suppress yields and hold them down. That weakens the dollar, and that gives you a boom for commodities.
Yeah, that's a really important point. And I'm glad you mentioned the impact of President Obama's spending on the actual makeup of the Congress, because right now you're talking about the Democrats really holding a very razor-thin lead in terms of majority here. So they want to jam in as much as possible while they have the lead. When you say the Fed managing what happens next, are you saying you're expecting the Federal Reserve to start changing its language at some point in terms of what they're going to do? I mean, we've seen this back up in interest rates already, right, to 1.7% on the 10-year.
Yes, and a lot of our institutional clients are overseas. We have clients in about 26 countries, and they just look at the foreign ownership of treasuries, Maria. It's down about 15-20% in terms of total foreign ownership, buying of treasuries. That means the Federal Reserve, through MMT or modern monetary theory, the Biden administration is going to force the Fed into MMT, modern monetary theory, and the Fed's going to have to make up for what the international investors are not buying.
All right, let me move on to what we saw over the last week, and that is the losses tied to that unwind of Archegos hedge fund. Mizuho is investigating possible losses of $90 million tied to deals with Archegos, according to the Financial Times this morning. We heard from Nomura and Credit Suisse. They have already warned of significant losses. Larry, what's your take? Who's exposed to that hedge fund unwind? Those wild swings we saw in stocks last Friday, it was amazing to see stocks like Discovery and CBS Viacom get so impacted by the unwind. Are we going to see a real impact negative on the banks, Larry?
Well, I'll never forget. I was so proud of you because you and I were doing it on the show, and back in 2009-10, and you broke the Repo 105 story. Your leadership there was incredible. And what Lehman Brothers was doing is they were taking $50 billion a month of leverage off the balance sheet, reporting the earnings, and then bringing it back on. So it was like a trick to hide the leverage. Here we are 12 years later, and the banks are doing, not the banks this time, now the hedge funds are using total return swaps and all these 21st century tricks to hide literally billions and billions of dollars of leverage. And in this case, one investor has hit the global banking system with about $12 billion of losses. At the end of the day, for people watching us right now, the implications are hedge funds right now, mutual funds, asset managers cannot trust their prime brokers, because the prime brokers, the banks on the street, right now, as a week later, can't calculate the losses, right? This is pretty scary. They haven't given us the number. A number of banks have not given us the number. That means that we're going to see a pretty substantial deleveraging as investors, hedge funds, mutual funds can't trust their prime brokers. There'll be a natural deleveraging process. And then the fun starts with the House and Senate hearings. And once Elizabeth Warren gets a hold of this, it's going to be just really entertainment time on television.
Oh, absolutely. Larry, those days were incredible. I remember during the Lehman collapse when I first got the call, and this was even before the weekend that changed everything when Lehman went under. But when I first got the call that JP Morgan wanted to acquire Bear Stearns for $2. Remember that? I said, wait a second. Are you sure? $2? I mean, I know ultimately he paid $10, but it was such an extraordinary moment in time, Larry. Real quick before you go, does anything today feel like what we lived through and what we witnessed during the failure of Lehman Brothers? Are you expecting any, significant decline in this market, given the worries of inflation and the higher interest rates and the spending, et cetera, Larry?
Well, just the speculation, the fact that you have just the extreme level of speculation, and the fact that one investor, literally almost took down, a large financial institution, that just tells you naturally the risk reward here is atrocious. You got 2 to 4% upside. You've got probably 30 to 40% down. But at the end of the day, you look at some big banks in Europe, Credit Suisse, UBS. They have a lot of exposure here. We're hearing from clients that there's going to have to be a capital raise, or at the end of the day, there may be a forced merger of UBS and Credit Suisse that's being speculated in the market right now. And so it won't be a Lehman-type disaster, but it'll definitely be a shock that's coming, and it's coming pretty soon. It's coming probably in the next 30 to 60 days.
Wow. Larry, we'll keep talking about this. I know that Credit Suisse UBS story has been going on a while. I want to keep talking about that and really taking a look at the landscape of this industry with you. Larry, great conversation. Please come back soon. Good to see you this morning.
Thanks, Maria. Great to be with you.